Welcome to Money Talks. We've got a really important show prepared for you today. Crypto markets have been in turmoil. The crypto Twitterverse is in full-on panic mode. Normally, this peak fear... Oh, sorry, I have some background noise here. Sorry, folks. Normally, this peak fear often signals a bottom. Ron Neuner from Crypto Banter, Vinny Lingham are here to get into this and more. Of course, Abra Bitcoin analyst Natalie is here to talk all things Bitcoin, and the Abra team is on deck, ready to take your burning questions. All right, let's do this. All right, look. In light of the recent turbulence, I just wanted to start out by reminding everybody, that we at Abra, we really take a very serious and conservative approach to risk. I get a lot of questions on this about how we collectively manage your funds, and we take this really seriously. And we also take a very conservative approach to how we manage our own balance sheet as a company. We pride ourselves on being safe, trustable hands. Our risk management processes are robust and they're efficient. We want to assure you that the recent volatility and dislocations in the market, including everything you've been seeing with the Terra Luna, UST, or any other algorithmic stablecoins, or any stablecoins for that matter, are not having any material impact on our business or your digital assets held with Abra. If you need any assistance, we're always here to help. Even if you're not an Abra customer and you need assistance, reach out to us. Our team is fantastic and they're here to help. We have live chat in the app. You can go into the app itself, or you can go to support.abra.com. In the US, you can reach us via telephone, 1-877-2-GO-ABRA from 6 a.m. to 6 p.m. Pacific time. All right, let's get into this. So today, we're going to talk. I'm going to skip all the stuff, and I'm going to bring Ron and Vinny straight in. I want to get into this. So let's bring. I've got a couple of people joining me today. You guys know them. They don't really need much introduction. I've got Ron Neuner from Crypto Banter, one of the most well-respected crypto shows out there. Vinny Lingham, longtime friend. Vinny and I have been in this strange journey together for almost a decade now. And Vinny's got a CEO of a new, really interesting video app, which maybe he'll tell us a little bit about. But we're here really to talk about crypto today. So can we just get right into it? And is everybody on? All right,
we're on.
All right. So thanks, guys. Thanks for doing this. Sobering week in the markets. Obviously we've had a small a recovery, but it was from an unbelievable low. I guess relative to the lows on Bitcoin, we did recover 15-20%, but really rough week. I mean, I don't know, Vinny, you start. What's your take?
So thanks for having me on, Bill, and it's good to be and good to see you guys. My take is that right now the Fed is driving all markets, including crypto. Crypto had a double punch. So we had the traditional macro picture, which has been hit us with the rising rates, and then you had this blow up of Luna. It's a 1-2 punch, right? So now we're kind of licking our wounds, and the real question is, can things get worse, and how does it get worse? And does it get worse as a result of macro factors, or are there systemic risks in the crypto industry that are going to make things worse?
Yeah. So do you feel like oftentimes I look at the crypto Twitterverse as, one of my favorite business books that I give newbies is always The Art of Contrarian Thinking, right? And the bottom line, it's not a long book, but the bottom line for the 150 pages is that when you have maximum fear, it may be time to get back on the bus. And when you have maximum greed, it may be time to get off the bus. And does it feel like we're at maximum peak fear now?
My sense is no. I think there's still hope. Maximum fear is when all hope is lost.
Mm-hmm. Yep. So is that like a big yet to come capitulation move? Is it more gradual pain and then Yeah,
one of the biggest issues right now is the overhang with Michael Saylor and the Bitcoin sitting on MicroStrategy's books and the potential margin call at 21,000, I think is the rough number.
He clarified the number is $3,500, and it's only on one very small loan from MicroStrategy. So I'm not sure that there is a liquidation number. He did clarify that. He came on Twitter and he clarified that.
Oh, I understand. Okay, so the rumor was it was 21,000, but he clarified it.
3,500, I think, is the number, and it's a very small loan which was taken by MicroStrategy, actually, not MicroStrategy, which is the subsidiary.
Okay, so this, but let me just like point out the point I'm trying to make really is when we have Bitcoin held in fewer hands, and highly concentrated, it presents systemic risk. So things like an ETF, as you know, Bill, I've been against it for 5 years plus, saying it's just a bad idea. People should learn how to self-custody Bitcoin, hold their own Bitcoin, put it in their own wallets, etc. And when we have like MicroStrategy, or in this case, Luna Foundation, LFG, holding all this Bitcoin, where if they become a forced seller, they're going to dump it on the market. Look what happens to the stability of the crypto industry. So I've always been an advocate of Bitcoin will be most successful when it's held in large number, in small amounts by large numbers of people, and it's very liquid. But we've got the whole scaling debate discussion around that and how that's not possible today. But this is the real issue.
Yeah. I want to get into what happened with Luna, the systemic risks. Ron, what's your take? Is the pain done? Is there more?
I have a slightly different view to Vinny. I mean, I agree with Vinny on the fact that the Fed is driving all markets. The Fed has one objective, and that is to reduce inflation. And to be honest, I actually think they're right, because I live in a country where I know what inflation feels like. I don't think that this generation of Americans know what inflation feels like. But I think if you go and ask a African, a Venezuelan, or an Argentinian, or a Greek what inflation looks like, they'll tell you that inflation is actually the worst thing in the whole world. It's much worse than a stock market crash, because it means that you just don't know the value of your money. And so I think the Fed is resolute in resolving inflation, and they'll do whatever it takes to solve inflation. And I think we've had one good step. We've had two good things happen. One is we've had a NASDAQ market correction of 25%. We've got everyone in fear and now in saving mode, so they're going to spend a whole lot less. Number one, basic. Number two, for the first time, we've had a decline in inflation. It's not really a decline, because we know that the base in April last year was very high, and when you measure something off a higher base, you're going to get a lower reading. But at least it's one step in the right direction. So we're seeing that. I think that there's going to be a lot more pain ahead, because until we get 3, 4, 5 negative inflation readings, and I think that we've got to be back at like 6% and 5% before the Fed says, okay, hold on, and that might be just in time for the midterm elections. So I think that that's where the Fed is. Now, let's go to what I think about crypto. I think that I find it hard to believe that we're going to see a lower low than what we saw the other night at 25,500 or whatever the number was. I'll tell you why. I think that we had a couple of things play out at the same time. The first thing is, for the first time since I've been in crypto, and I've been here since 2015, I know it's not as long as you and Vinny have been here, but for the first time since I've been here, we've seen a real layer one capitulate in one day. And when I say a real layer one, a significant monster layer one with a $40 billion market cap, with a $20 billion stablecoin attached to it, and with another $25 billion in market cap of related projects, the DEXs, the exchanges, everything else that goes around it. And we had that capitulation in one day. And we had all the unwinds of all the liquidations in one day. That's a cataclysmic event that crypto has never, ever seen before. Certainly not since I've been here to this magnitude. I said it earlier on my show, but if you think about Enron, and I know the value of money was completely different, but when Enron collapsed, that was a $60 billion collapse. Now you're talking about this Luna event was above that in dollar terms. Obviously, the dollar is worth a lot more. But just give me, this is not a small thing that's happened to crypto. This is a big thing by world standards. By world economic standards, a collapse of an $80 billion protocol is something that we've never seen before. And I'm actually quite surprised that with that and the fact that LFG had Bitcoin, and I don't think that LFG have sold all their Bitcoin, Bitcoin still held 25,000. I mean, that is a massive achievement. And what I think is that if that hadn't happened, then I think we probably would have been at 35 or 36,000 or maybe even 37,000, because Bitcoin was doing quite well there. And so I think maybe the crypto market has seen a temporary bottom. I think anyone that needed to be liquidated has been liquidated. I watched the liquidations. It was a sight for sore eyes. And now I think we may start seeing some kind of recovery. I don't think it's going to be a quick recovery, but I'm not sure we're going to go much under 25,000.
Vinny?
Yeah, so the support level really is around 25K. And it's a pretty heavy support level. If we lose that, there's a good chance we go below 20. So the real question is, do we think that it breaks the top of the last cycle? I think given everything we know today, all the known knowns, I think that's very unlikely. I think it's the unknowns that can hit us, the black swan events, the potential unwinding of. I mean, we don't know right now. Nobody knows what the knock-on effect of this Luna collapse is to the broader ecosystem. We don't know what exchanges are running fractional reserves and storing value in Luna. We don't know which hedge funds have gone under and they haven't told anyone about it. We don't know what a run of the bank is going to look like if the contagion from Luna spreads. And it's an $80 billion asset. You cannot tell me there's no contagion. Right. So this is my concern. And the question is twofold. It's like how long until the unknowns become knowns, and how quickly the information comes out.
So I want to get into Luna in a minute and stablecoins in general, but let's just I want to at least get all the opinions out there from a macro perspective, right? So if I put my Raoul Paul, Cathie Woods hat on for a second, what I'm hearing there is that the bond markets have done their job. The economy is slowing dramatically in the US. We're probably either in recession or about to go in recession, which means that, to your point, Ron, they do need to tighten. But honestly, interest rates would, if they really cared about only inflation, interest rates would be at 10%. So clearly they care about more than inflation.
But hold on, the mandate of the Fed isn't, inflation is
no, I know that. I was responding to what Ron said. So my point is that I think what's going to happen is they're going to recognize that we're basically we're in a recession. They're probably going to again, Cathie Woods, Raoul Paul perspective is we stop tightening in June after we do another round. Or we stop tightening after the June tightens, and we basically say, hey, we're basically, the economy slowed too much. The bond market has done its job. Vinny, you're shaking your head. You don't agree with Raoul and Cathie Woods on that?
No, I don't. I think they've been wrong, and they've been wrong for a while now on these things. In all due respect, I think the vectors that they're missing is the Fed cares about unemployment more than anything, and unemployment is still very, very low and dropping. And so they care about making sure that number doesn't go up. They don't want 10% unemployment in the US. They're trying to get unemployment down to near zero. So the next thing is they are tightening in June when it comes to the bond selling. They're going to have to sell the bonds. $50 billion a month is going to go out the door. So yes, they may decide to do the quantitative, so stop the tightening of the rates or raising of rates, but they're still going to sell the bonds to unwind the Fed balance sheet. What do you do in an illiquid market when you're trying to drop $50 billion a month in bonds? I mean, on some level, you can actually turn those assets toxic, right? Because there's just too many sellers. And so then they've got another problem to deal with. I don't believe the Fed are intellectually capable of running this country anymore. And I don't think they're going to be able to navigate us through the worst. And that's what's getting, so my belief is the worst is going to happen, and I don't think they can stop it.
Vinny, can I play the other side of this? And I know it's not a popular crypto opinion to actually play the other side of this, but someone posed a question to me and I sat there with a mouthful of teeth. So if you were the Fed when COVID happened, you had no choice but to put more money into the system. There was really no other choice. Are we in agreement on that?
100% agreement.
Okay, now the only place that you can floor the Fed is that they maybe reacted 2 or 3 months too late, because they probably could have started tightening 2 or 3 months earlier than they started tightening, right?
Correct. A much more slower slope.
Yeah, so I think unfortunately the Fed is in a scenario where they're caught between a rock and a hard place, because again I think that if you were to ask me what would I prefer? Would I prefer inflation, or if I was running a country and you ask me, would I prefer inflation or would I prefer a stock market collapse and a depreciation in the price of assets? I take a depreciation in the price of assets 10 out of 10 times.
Why?
Because
Why?
Why? I'll tell you very simply why. Because in most countries, the majority of people own very little assets. The majority of people have very few investments, very few.
Right.
And so if you ask me as someone running a country, not as someone who's in the top 1% of people in a country and I have assets, but if you ask me if I'm protecting a country and I'm wearing the hat that Joe Biden, the Fed, Jerome Powell, governments are wearing, I'm saying, hold on a second. My only priority right now is inflation. And I'm going to do everything it takes.
They're wrong. They're wrong, and you're wrong. I'll tell you why. Let me make it. I'll give it in very simplistic terms, right?
Okay.
People with assets that get inflated. There's an entire discussion on that. Put that aside. If you're a wage earner and inflation's high, companies do adjust your salaries at an aggressive rate. They have to. You know, from South Africa, what matters more is.
But they don't. 20% inflation and they adjust your salary by 2%.
Oh, we're not 20%, right? We're not 20%.
Yeah.
Okay, and the second point is inflation is not uniform. Okay, you know the headline number of whatever 8.3% is not uniform across all goods and services. There's used cars are up, this is down, etc., etc. So the inflation measures are inaccurate at best.
Can we agree that the number is higher than 8.3%?
But
for anybody.
In what category?
For anybody.
No. You're talking about price inflation. I'm talking about there's monetary inflation and price inflation. Price inflation is not uniform. Do we agree on that?
Agreed.
Okay, so the concern, from our experience, we're both South Africans, and living in South Africa, wage inflation, people always got paid more. The 10% a year increase is something people got used to in South Africa. You know that.
Yes.
But inflation was high. So wage earners earned more because companies didn't have a choice. Even in a high unemployment market, you still want to retain your workers, you still pay them more. Because of inflation.
Any company this year in the United States that increased salaries by 8.5%?
Okay, but hold on. We're talking about two different things here.
Okay.
So living costs have spiraled in certain areas and parts of the United States. And the reason it spiraled, and I was looking at like median home to income ratios yesterday. It looks bigger than the 2008 bubble in housing, right? Everyone agrees on that number. The number is wrong. It's wrong for a reason because we've had massive.
Victor, which number are you saying is wrong? The housing numbers?
The medium, the income to housing price. So they're saying it's a bigger bubble than 2008, and it's actually not. And I'll give you the reason for it. The reason for it is capital migration. There's been a massive amount of capital migration out of Silicon Valley, which is a big portion of the capital in the US, out of California, into Austin, Texas, into Miami, into a number of different small, lower cost cities and towns. And that capital has pushed the price of housing up because people come in there, they buy their homes, and you've seen this all over. So there is a capital reformation in the US, which is skewing the numbers. It's not housing inflation prices are up because the price of the dollar is going to be It's capital's moving from $1 million apartment, one bedroom in San Francisco. Exactly. So that's part of the issue. This is we'll never get through all the ins and outs of this.
So the bottom line is that, look, we all agree that there's inflation. There's huge disagreements across the board from anybody who's in the know even on what the response from the so-called powers that be is going to do. The bottom line is we don't know. I'm guessing they don't know at this point because they're figuring it out in real time, flying by the seat of their pants, which is probably the most disconcerting part of all of this to me, is basically they're either asleep at the wheel, drunk at the wheel, or some combination.
Intellectually incompetent. Like these are guys who grew up in like post World War I era, right? They don't understand the world is today. And I'll add one more thing.
Vinny, if you were head of the Fed, what would you do? If I was
the Fed right now, I would produce a UBI to help people in the low income categories. No, hear me out. Okay, the one thing I think about UBI that's interesting is if you give away money so look, there's lots of views on UBI. I think that we have to move towards a UBI system in the US. And I'm a capitalist pig. Like I believe in capitalism. I still believe UBI is important. And the reason it's important, and I'll give you a quick example. If everyone in the US got a $2,000 a year or $1,000 a year citizen dividend, right? To run, it's irrelevant. Or to you, Bill, myself, it's irrelevant. But for a guy who's earning 20 grand a year, it's a big deal. And you increase that number. But if everyone gets the same amount, it's fair, right? And it comes out of the inflation of the currency. I'm not one of those people who thinks inflation is bad. I'm one of those people who thinks that like moderate inflation is actually healthy in a growing economy. But if the economy starts, if you go into a recession, the economy is not growing, inflation will destroy us. So that's the worry. You can maintain high amounts of inflation for long periods of time as long as the economy is not in a recession. If the economy is in a recession, that's what causes the problems.
I'm taking the flip side of it, and I know it's the most unpopular opinion in the world right now, but I'm going to say that I think what Powell's doing is the right move. Front load, let's take the pain now up front. It's like chop this thing off, take the pain up front. We're already in a quarter, go into a second quarter, go into an official recession, take the pain up front, and then let's start again and let's do this thing slowly. If I was sitting in Powell's position, look, I haven't thought too much about the case of UBI. I'm not a big UBI fan personally, but maybe there's Vinny, maybe we need to have a bottle of wine one night and you tell me your view.
Well, you need to do that anyway. So clearly.
Vinny and I often have those kind of evenings. So what for me, I think it's a very unpopular opinion, but I think rip off the Band-Aid and do what you need to do, and let's have 3 months of pain, and let's get the shit behind us and carry on. Okay, because inflation is the worst thing that can happen.
All right. So I think what's really interesting about this for people, and I'm seeing some of the comments, is that, I love watching you guys, have these perspectives, because it actually helps me. And I watch Raul, I watch Kathy, I've listened to Ron, I listened to you, Vinny, Dan, and some other folks, and everybody's got a slightly different perspective on this. Morehead thinks spot markets are going to shit. Raul thinks that the chart of truth is coming back, and they couldn't be more diametrically opposed, and yet they're both holding Bitcoin. So let's use that as a segue into crypto. So we were talking about this before the show. Clearly the big news this week is the UST Tether Luna DPEG. Luna is being delisted now all over the place. It's effectively gone to zero. Ron, we'll start with you this time. What's your perspective on what happened and why?
Okay, so what's my perspective on what happened and why? I did a very deep analysis because, as you know, it was a big part of my portfolio. And in fact, today, only 2 minutes before the show, we did the full post-mortem on the size of the portfolio that it actually represented. And it's a tragedy. What happened to me, I don't know anybody who's had such a big knock on their own personal portfolio. And the reason why is because I made some very basic mistakes. I'll give an example. I invested in the Luna protocol because I believed in the stablecoin, which everyone believed in. But then I kept my dry powder in the stablecoin because I was earning 20% on Anchor. And at the time, never did I look at it and go, hold on a second. If it succeeds, I'm going to get a 10x, 15, 20x return just by holding Luna. I didn't do that calculation. If it fails, I'm going to lose both my stablecoin, my dry powder, and my investment in the protocol. And all I'm getting for that is a 20% a year.
Oh boy.
I should have rather been in USDC, gone into Abra, put the money in USDC in Abra, earned less, maybe 10% or whatever the number was, and slept well at night. That was one of the mistakes that a lot of people made, not only Ron, a lot of people made that mistake.
So by owning Luna and using Anchor, effectively you were doubling down without actually looking at it like you were doubling down.
And then I also tripled down. The reason why I tripled down is because I owned Luna, I owned Terra, but I also invested in every single company that I thought was going to build the ecosystem. So the lending protocols, I was an investor in Anchor, I was an investor in Mirror, I was an investor in the DEX, Astroport. And so initially, when Luna went down, my initial thought was, oh my goodness, I've lost all my Luna. And then a couple of hours later, I was like, oh shit, hold on. It's not only Luna, it's my dry powder, and it's my whole ecosystem investment in the ecosystem that I felt most passionate about. And the example that I use to most people is to say, imagine Ethereum went down. You don't only lose your ETH, but you're going to lose your AVA, your compound, your everything else that your US or whatever else you use it. So, I mean, that was the mistake. Now, where do I think that the protocol went wrong? Well, I have a few questions. I have a lot of questions. The first question is whether now I really question the viability of an algorithmic-based stablecoin. There hasn't been an algorithmic-based stablecoin that's ever worked in the past, and there hasn't now been one to date, and they all fail on the same thing, which is the death spiral. That's, in fact, the only algorithmically backed stablecoin that currently succeeds is the US dollar, because it's not backed by anything, and because it has the biggest backstop in the world.
Sure, the algorithm is manually run by some white-haired old men.
It's a centralized coin.
But let's take rewind, because I know we've got people who watch who aren't that advanced on this stuff. So USDC, Tether, in theory, are asset-backed stable coins that are theoretically fully reserve backed by dollars and dollar equivalents in a bank account. Algorithmic stablecoin basically uses some algorithm to base the value of the stablecoin or peg it to something like $1 by basically moving other assets in or out of something like a smart contract, right? And so what you're saying is now segue that into your comment on the run that you were starting to explain.
Bill, the way I see it, there's three types of coins. The first type of coin is a coin that's over collateralized. So MakerDAO is over collateralized. It has more collateral than what's in the stable coin underneath it. And USDT apparently is also over collateralized because they have made profits on the investments. Yeah. Then you've got a one-to-one backed, which is Circle, and then you've got an algorithmic backed stable coin, which is not backed by anything except arbitrage. So when it gets under the peg, they count on people to buy it back and bring it back to the peg. And when it goes over, they count on people bringing it down. We've never seen an algorithmic-based stablecoin work. There isn't one that has worked, and Luna Terra was the first one that almost worked. Where do I think they made a fatal mistake? So I think they made a fatal mistake when they lost their identity. And what they said is, we are an algorithmically backed stablecoin, but we are also now going to collateralize our stablecoin to a certain extent. And when they said that, when they came out and they bought $3 billion worth of Bitcoin to collateralize $20 billion worth of a coin, they effectively found themselves in a very strange place. Because when you have a $20 billion collateral, but a $20 billion float, but only a 1.5 or 2 or $3 billion collateral, you're an uncollateralized stablecoin, and you open yourself up for attack because anybody says, hold on a second, you've got now $3 billion. They went out into the market and they publicized the fact that they had $3 billion worth of Bitcoin, and they publicized the price at which they bought it. At that point, any smart person would have looked at this and said, hold on a second, 3 billion is backing 20 billion. And the 3 billion, as soon as the price of Bitcoin comes down, becomes 2 billion and 1.5 billion or whatever the number is. And then it becomes very, very, very easy it becomes an attack vector, because what you know is that as soon as you dig through the 1.5 billion, it's game over and you go to zero. And then it becomes a trader's paradise or an attacker's paradise. And specifically Wall Street, that had been doing this for many, many, many years. George Soros has been doing this for many, many, many years. They know the metrics. And so where do I think the fundamental fault was? The fundamental fault was where they crossed the chasm and they said, we are now a semi-collateralized coin, because there's no such thing. You're either uncollateralized or you're fully collateralized. But if you're semi-collateralized, you're not worth anything. And that's where I think they made the biggest mistake of their lives.
So Vinny, you were nodding at that comment. What's your take?
Yeah, I think this is the problem. I mean, okay, so I've had a number of chats on Twitter Spaces the past couple of days, people asking these questions. So if you've been listening to that, I apologize, but I'll reiterate it. If you want the safest possible stablecoin right now, it's effectively, well, I wouldn't say stablecoin, but safest dollars, it's $100 in a FDIC insured bank account, right? That's the safest money. The next safest money is USDC. Because it basically is almost the same as FDIC insured, and they're proof of reserves and it's regulated, etc. And then as you get away from USDC to other stable coins, the risk goes up. You get things like counterparty risk, regulatory risk, etc., etc. So the value of $1 on Luna 2 days ago was, in my mind, was never equal to $1 in a US bank account or $1 at USDC, but it was trading at that. So there's this arbitrage opportunity that occurs, like, well, can we break it and can we get the difference? And it's basically a huge red flag for hedge funds who have got massive balance sheets and the time and energy right now to go after these things. And whether they went after Luna or not is irrelevant. But what happens with stablecoins is the moment you start adding additional risk. So what I always say about crypto is risky. Everything in crypto is risky. When you start compounding risks, what do you get? So this is the problem. So if you want to have a stable coin, you got to try and go as far to the left as possible and be as close to a US dollar as possible for a stable coin. Now, on the other side of the equation, so let's look at the two types of stable coins right now: algorithmic and asset-backed. And with asset-backed, you get dollar-backed, so that's the safest. And then you've got asset-backed, which is Tether. So Tether isn't 100% dollars. They've already said that they keep some sort of required reserve, 5%, 10%, whatever it is. And then they've got liquid assets, including Bitcoin, stocks, bonds, commercial paper, etc. So if there was a run on Tether, you'd have to eat through about $8 billion worth of redemptions to get into them having to start liquidate positions, which is a lot of money. Maybe it could be done by a syndicate of hedge funds, maybe not. Who knows? It's a lot more. But what Luna showed was, with a very small amount of liquidity requirements, it triggered a run in the bank, and they couldn't liquidate the other positions fast enough. And then the value of the assets started dropping. So Bitcoin was dropping, etc. And then it basically becomes uncollateralized. And that's when you have this liability. And then, and because Luna was a kind of an asset-backed, but based upon a stable coin, an algorithm, it was kind of a weird compounded risk situation. And then you get more to the far right, where you got stuff like UXD, which is a lot more interesting because it uses delta neutral positions to hedge, and it can actually maintain the stablecoin itself based upon that. And there are some good financial principles around that work. So we are still in a testing phase in crypto. We're testing these models out. We're seeing what works, what doesn't work. But we have to be intellectually honest about what the risks are for each type of stablecoin in this market. And so the intellectual honesty comes with saying, yes, USDC is the safest stablecoin. And then there's a spectrum from there to Luna. And maybe UXD proves itself as being a better stablecoin, and that's great. We've had DAI for years. We've had others. But they're unproven. So in the real world testing environment, we have to determine over the next couple of years what is closest to safety. Now, the other question is, why don't people just want USDC? Well, it's highly regulated, it's centralized. The US government, can seize your funds, etc. It's not ideal if you live in an oppressive country, or you're trying to evade the tax authorities in your country, or move money offshore. It's not the ideal currency for you. But it is the safest if you're a law-abiding US citizen and you don't have to worry about those factors. Yep. So people don't want USDC for other reasons for having it.
Right. And a couple of comments, right? So whether it's USDC, TrueUSD, and there's a couple of other US-based ones that are much smaller, they're not FDIC insured because FDIC insurance only applies to named individual bank accounts up to a certain threshold. But because they're effectively money transmitters or trusts, they're required via their licenses to maintain 100% reserves. So in some ways, it's actually safer than the bank, who's basically able to lend those deposits, which is actually an interesting phenomenon. So the other thing I would say is, I have my big problem with all of this, because I came up through traditional software development, is that we don't really seem to have a test phase, right? A lot of the basic concepts of the internet were developed over decades in university labs. Right, PhDs in computer science who were committed to basically doing things that were fun for them, and there was no thought to, oh my God, I'm going to spin this out and get a whole bunch of options in my company, and I'm going to be a trillionaire, and I'm going to give all my money to charity. They were just interested in the shit they were doing. And so now, because everybody can tokenize what they're doing and push it out there and become a gazillionaire overnight, we seem to have lost sight of this idea that it takes a long time to rebuild infrastructure, technology, software, even if it's software. And we're just pushing stuff out there and saying, go use it. And I'm guilty, right, for sure. And we're just pushing stuff out there without any regard to the consequences, because we can. That doesn't mean we should necessarily. Right?
We test in adoption, which is it's crazy. We test in adoption, and our investors are our adopters, and that's where I think that's where the conundrum of what you're saying is. People are testing in adoption, and the adopters are the investors.
This is the problem, Brian. We're testing with the wrong audiences. We're testing with the mass market. The biggest red flag for me is with Luna was the same red flag I got from BitConnect. Look, free money, easy money, and people who have no idea what happens and how it's done. 99% of people who put money into Luna could not tell you how an algorithmic stablecoin works.
Sure, but they also couldn't tell you how proof of stake works.
But
or how the banking system works.
But Bitcoin.
That's not the same thing as testing something versus not testing something.
I disagree. As a community, we spent a lot of time with Bitcoin in the early days with a very small community of pretty intellectual people understanding it and vouching for it, etc. There was a high signal ratio in Bitcoin early days, and there was a high signal ratio in Ethereum as well. Okay, what you find with these other environments like Luna, for example, it was actually pretty low signal, right? I didn't know anyone from the OG space, people myself, you, like excited about it. No offense, Run. Run came in a little bit later, but people from the 2012 to 2017 era, none of us were excited about Luna. I mean, we're kind of like, okay, but the moment it got to some level of scale, we were like, this is crazy. And the amount of people supporting it were retail investors, which made me really, really concerned about it.
You know what I want to, another thing that we saw with Luna is when Luna made the announcement that they were going to back themselves to a certain degree by Bitcoin, Luna became the biggest. It was almost like a genius move, because what Do Kwon managed to do was he managed to get the support of the Bitcoin community. And you all of a sudden had him on all these Bitcoin podcasts and, Pump and everybody else, Do Kwon.
He's on Money Talks. Yeah.
Yeah, and then when the protocol collapsed, the biggest grave dancers were the Bitcoin community. The ones that were dancing all over the grave were the Bitcoin community who treated this guy as a hero because he was buying so much. And then when he collapsed, they started grave dancing. And
let's not conflate the two issues here, okay? The Bitcoin community is massive. It's like 100 million people worldwide. You're going to get all sorts of people in there making noises. What I'm saying is I'm in a lot of Telegram groups with Bill, and like we're talking about the OGs of the space who understand the space, and they're not the ones cheering on when Do Kwon's buying Bitcoin. They're not the ones dumping on him. They're the ones saying, challenging the what this thing does and will it work. And when I look for signals, I look for other smart people who've been around long enough to say this is good or bad. But the noise to signal ratio with some of these projects is scary. When you have millions of people who know nothing about the stuff buying it, I get worried.
Yep. All right. So I want to move on. Last question. You guys have been great. So we talked about this before the show, and we talked about it a little bit at the beginning, but, one question for each of you. Two questions for each of you, maybe 30 to 60 second answers. What is the biggest risk to the crypto markets right now? And is there a specific catalyst that you think propels us forward? Vinny, go ahead. Oh, you're on mute, Vinny.
Oh, sorry. Look, the biggest risk really is an unwinding of all the stable coins out there, right? And there's a lot of them, and then maybe not all the scale of Luna. Obviously, Tether is bigger. Tether is backed, I think, sufficiently backed that there isn't a asset risk on Tether, but there is a liquidity risk on Tether, and that's the issue. And so, in a run of the bank, could you get your money out? I mean, like I said, you probably need $8 or $10 billion to create a liquidity crisis in Tether. So it's probably not a significant risk. But the other coins, I'm pretty sure they were doing similar stuff to Luna on some level because they're all competing for returns. And I would be, if I was in, my advice to people here is if you're in any stable coin, other than Tether, probably, I would start migrating off to USDC or Tether. And it's better for us to concentrate the stability of those into those coins than
it's centralized anyway.
Yeah, it's centralized anyway. What difference does it make, right?
And what's the catalyst in your mind that could propel us to the moon in the next 6 to 12 months?
Right now, I think that we are at the behest of the Fed. I don't think we have any catalysts right now.
Fair enough. Ron, biggest risk to the system today?
I'm going to say the biggest risk to the system today is also the biggest opportunity for the system today. ETH 2.0 merge. And I'll tell you why. Because ETH is, we've just seen the collapse of of a $35 billion protocol, but ETH is 10 times that. And we don't know what we don't know. We think it's all going to go okay. And the probability is probably pretty high because you've got a lot of the smartest minds in the world working on it and testing and delaying, which is, for me, every time I hear a delay, it's like, thank God they're delayed. Let's rather get it right. But I mean, let's just play this out. what if something does go wrong with ETH 2.0? Let's just play it out. We think it won't, and we hope they test it enough, but what if something goes wrong? So that for me is the biggest risk to crypto right now. Everything else, the Fed and that's we're going to just move with the markets. I think the markets have seen enough pain. Maybe they'll see a bit more pain. But if you're talking about cataclysmic risks, ETH 2.0, the biggest opportunity to crypto right now, the biggest catalyst to crypto, ETH 2.0, because there's two tokens that funds can invest in from a liquidity point of view, Bitcoin and ETH. Everything else is too small for real money. You've got one of them which is theoretically not ESG friendly, and doesn't earn any kind of real yield, and then all of a sudden you've got a second one which is liquid enough, has huge adoption and uptake so they can justify their decision, is ESG friendly after when it goes on to proof of stake, and gives you a between 8 and 15% yield depending on where it ends. And that could become the ultimate catalyst for real institutional money starting to flow into crypto. So I'll sum it up by saying the biggest threat to crypto is also the biggest opportunity to crypto in the next 6 months, if it is 6 months.
So ETH 2.0. All right. So I'll give you my quick answer. One, I think the biggest risk right now is if we get a massive increase in inflation, which I don't think is going to happen, but if it does happen, meaning, the reported number, not the real number, but the bullshit number actually ends up in the, 13, 14, 15% range, I think we have a crash that makes 87 look small. And if that happens, it just basically pulls Bitcoin all the way down sub, 20,000. Now, I don't think that's going to happen, but to your black swan, Vinny, I think that would be probably the most realistic black swan that I could come up with right now. But honestly, I think while I'm bullish on Ethereum 2.0 as well as potential catalyst, I think the more likely catalyst is that the economy is slowing. And what's going to happen, what could end up happening is the IMS number, the yield curve, bond markets all basically show we're in recession. Fed has no choice but to slow, even at the risk of more inflation. But it looks like the fact that it's going to take a while for oil prices to unwind could balance that out, means that asset prices start to basically move up and to the right again, which is actually what I think is going to happen in the second half of the year. So anyway, guys, you're awesome. One of the things I really respect about you guys, besides the fact that you're so smart, is that you're willing to come on here and we're all friends and we love to actually disagree a little bit and get into it. It helps. I think it helps everybody. I'm watching the comments, by the way, in real time. You guys have I can tell who gets the comments and who doesn't when you're on. You guys get fantastic comments. And so people really love the banter, the crypto banter, which you should check out anyway. And by the way, I've been looking at Vinny's new company, so you can follow Vinny Lingham on Twitter and get a link to his new video play, which I think is pretty cool. So guys, thank you so much for doing this on a Friday. I know you're super busy, and I really appreciate you doing this, and so does the Money Talks community. Thanks a lot.
Thank you, guys.
Thanks, bro. Thanks, Brian. Great, guys.
Ciao, Vinny. Good to see you. Ciao, guys.
All right, take care. All right, so thank you so much, guys. That was awesome. I think that's going to get a lot of rewatches on YouTube. So up next, we've got Natalie here. I know Natalie is chomping at the bit to give us her awesome update, and she's also going to give us a bit of a perspective on the Luna breakdown as it relates to Bitcoin. And potentially the latest push to regulate stablecoins, which I know is a concern for a lot of you in the comments. I'm seeing a lot of comments on fear. Is the U.S. regulator going to, are the banking regulators going to overregulate stablecoins as a result? Before we get there, if you're looking to maximize your crypto, then Abra is simply the must-have app. We talked about our risk management earlier. Trade, earn, borrow. We've made it safe, secure, super simple to do it all with just one app. So check out how easy it is to make trades with Abra. Hit it, guys. All right, Natalie, you're up.
Trading on Abra is easy. Just click the exchange button. Tap the source you'd like to trade. Tap on what you'd like to trade it for. Type in the amount. Then click trade. Tap, type, trade. Totally easy on Abra.
All right. Abra's awesome Bitcoin analyst, Natalie Brunel, is here with a closer look at some monumental news in the markets. Hey, Natalie, how are you?
Hi, Bill. I'm doing okay given the volatility.
Yeah. But by the way, before you get into your update, one thing I got to say. So I watched your Michael Saylor interview twice, and it was awesome. And so I'm just going to give you a shout out. Everybody go to Natalie's podcast and YouTube page, watch it, rewind, watch it again. There's a lot of detail in there that you got out of him that it's very hard with a lot of his interviews because, he just, everything just reverts to hodl, everything in the world will be fine. But you actually got some detail out of him that I hadn't heard before. So kudos for that. I actually was rewinding, watching and learning. So really well done.
Thank you. I really appreciate that. It's funny. People ask me, how do you prepare for interviews with Michael Saylor? And I'm like, well, you only really have to come up with 5 questions because he talks for like 5-10 minutes for each one. So yeah, everyone check it out. He does address some of the things with the Luna Terra meltdown, as well as some of the headlines that you might have seen out there claiming that there's a $21,000 margin call. He wanted to clarify, whether or not he has to sell. So I urge people to check that out. And thank you, Bill, for mentioning it. But, where I really want to start out is I'm sure, Bill, you've been getting these messages. There are a lot of people out there that I think are really nervous and really scared right now. There are lots of people that got into Bitcoin in that 45, 50, 60, 69 range. And I feel for them. I really feel for you guys. I've been buying all the way up to the top. And I think so many of us, especially late last year, thought that we would see the all-time high go way higher than it did, and maybe even potentially break the 6-figure mark. And then if it were to unwind a little bit and sell off, that it wouldn't dip quite this low. So, I see both sides, right? Because it's nerve wracking and you feel like, oh, if I just would have waited, if I knew this sale was coming, then I would have bought then. And I certainly feel a little bit of that way. But at the same time, we have so much volatility in this macro environment that we've been talking about on this show that's really impacted the Bitcoin price. And this is truly a great accumulation opportunity. These prices, I'm sure none of us expected to see. And, it's probably more fearful and painful to buy when it's in the red. It doesn't feel as safe, but that's actually the safest time to buy. When it's in the green and it's at these all-time high levels, that's the place where, you could potentially be regretting your decisions later with any investment. So I urge people to just kind of zoom out. Like we always say, this is something where you buy it and you're not supposed to check the price every day. You don't purchase a house, you don't invest in real estate and then check the value of that price every single day. And I think the same goes for Bitcoin. I have to check the price every day because it's my job. But other people, if you're in other industries, I just say, zoom out. And if you can continue to dollar cost average, these have been better prices to get into, and it could be a really great opportunity when the price does go back up. But, that said, I do acknowledge, I think the headline the other day was more than $200 billion erased from the crypto market in general as the sell-off deepened. And we could see a little bit more pain. I mentioned that in my news hit last night when I was on Tucker Carlson. There might be more pain ahead because the Fed is going to continue to tighten. I think that they're okay with the equities dropping. We had basically an asset bubble that was created as the result of all the money printing in response to the pandemic. And those equities have to come down. And we're not in a scenario like we were in 2008, 2009, when really the banking sector was on the brink of collapsing and failure. So I think they're going to let it unwind a little bit further. Again, it's going to be more painful. But eventually, it's kind of like what Ray Dalio says, the money printer has to kick back in because that's the only way that we're going to service our debt. It's the only way really we function in this country at this point. We do have elections. So I think maybe the inflation numbers will come down and the Fed might pivot maybe around the summer. They'll claim victory on inflation and the money printer will go broke again. That's at least my personal opinion. But let's get into some more Bitcoin headlines because there are lots of things in the news. You might have heard there's a new crypto company called Mara. It's backed by Coinbase, and that'll advise the president of the Central African Republic and help the country with developing and executing its Bitcoin strategy. So if you recall, the Central African Republic was the second country behind El Salvador in the world to make Bitcoin legal tender. And that country has suffered a lot of hyperinflation events, concerns about colonialism with their official currency, which is the CAF franc. It's essentially a derivative of the franc. But there are also lots of challenges ahead with adopting Bitcoin because only 11% of the country's 5 million people currently have access to internet. And you need the internet in order to adopt Bitcoin. So From what I've heard, Mara is essentially a local crypto exchange. They secured more than $20 million of funding, and they're going to try to expand. They're going to try to invest in products that will target actually multiple countries in Africa and help boost the adoption of Bitcoin and also other cryptocurrencies. And the World Economic Forum estimated that between 2020 and 2021, crypto adoption in Africa grew by more than $100 billion. And I think this is one of the regions that we need to put a big spotlight on because they have a lot of currency issues, oppressive governments, they deal with remittance fees, other challenges as developing nations. And so I think we really need to monitor what Mara does. And I think there's going to be more movement there when it comes to adoption. Some other highlights and headlines just to go through quickly. Brazil's largest brokerage firm, XP, announced it will offer Bitcoin trading. Japanese investment bank Nomura started offering Bitcoin derivatives to customers. Emirates Airlines said it will accept Bitcoin. I want to fly Emirates. And the German Ministry of Finance said Bitcoin gains will be tax-free if held for more than a year. I wish that was the case here. Australia's first spot Bitcoin ETF was listed and started trading. And a lot of people, as you might know, are pushing for the SEC to approve Grayscale's application to convert GBTC into the first Bitcoin spot ETF in the US. Remember, we have the futures, which creates synthetic versions of Bitcoin. We really need a spot ETF. And that conversion could unlock $8 billion for investors. And this is something you can actually help advocate for. If you want to see it happen, Michael Saylor was among the Bitcoiners that posted a link to a place where you can essentially petition, let regulators know that you support this, you want this to happen, you want the SEC to move in this direction. I am one of those people that actually thinks that the spot ETF will really help with Bitcoin's price discovery. I think it will help allow for on-ramps for institutions. So I really want to see this happen. And if you're more interested, I know Michael Saylor tweeted that link. Speaking of regulation, this week, by unanimous vote, 7-0, the Financial Accounting Standards Board, FASB, agreed to add a project to review accounting for exchange-traded digital assets and commodities. So essentially, this could make it easier for big companies to hold and report Bitcoin on balance sheets. So, but what would need to happen is essentially a redefinition that would move Bitcoin into the category of traditional financial assets. And that would make it a lot easier, essentially, for firms like MicroStrategy, Tesla to accurately report their holdings instead of reporting them at their lowest prices under intangible assets, which I know some companies have been affected by that. And I actually think that one of the reasons that this vote happened, we also heard Janet Yellen commenting on a regulation, is this, the biggest story of the week, the Luna Terra meltdown. So there's been this greater call for regulation, what's going to happen with stable coins, what's going to happen with crypto. And I saved this for last. I feel like you guys already did a great job talking about this on the show, but I'll kind of go through, high level. We've talked about it before, but the Luna Foundation Guard was behind this algorithmic stablecoin. They were buying up a lot of Bitcoin with the goal of making this a Bitcoin-backed stablecoin, trying to acquire 10 billion in Bitcoin. I think at one point, Do Kwon said he wanted to hold as much or be the second biggest holder behind Satoshi. And so when this all shook out, I believe they had in holdings more than $4 billion worth of Bitcoin. Lots of Bitcoiners, including Nick Carter, Preston Pish, Corey Clipston, they were calling this project out a long time ago. They shared their skepticism of it, but others thought it was going to be a really innovative experiment that had a real shot. And I'm really sad to hear, postings on Twitter about people essentially losing their life savings. This project essentially suffered a bank run and hyperinflation. And now the supply of Luna, it exploded. It suffered what is essentially similar to what we saw in Weimar Republic. I mean, they went from, I think, a couple million Luna tokens to over 7 trillion. And the value went from over $100 last year per token down to fractions of a cent. So I know people lost a lot of money, and I really, really, really feel for them. But at the same time, this is an example that crypto is really probably the most capitalistic free markets industry that we have. There is no mama bear that's going to run in and save the day. There are no bailouts. Like this is what happens. Risk is rewarded, risk is punished. And so I think we're seeing that play out. But for those of you that are maybe unfamiliar, I had a hard time really understanding this algorithmic stable coin, but I'll do my best. So UST was a Terra coin. It was supposed to be a stable coin, which means it's designed to retain a value of $1 at all times. didn't depeg just a little, it crashed violently, very, very, very quickly. Other stable coins are reportedly backed by actual US dollars and reserves, although there are concerns about that. I know Caitlin Long is, I think, calling out Tether right now. But with Terra Luna stablecoin, the idea was to have this algorithm plus billions of Bitcoin reserves to maintain the peg. And in order to create Terra, you had to burn the Luna token. So when it was, say, $100 per Luna, you could trade one Luna for 100 UST or Terra. And this deflationary protocol was supposed to spur long-term growth. So the more people bought into UST, more Luna was burned. That would reduce the supply. That would make the remaining Luna supply more valuable. But then, as you probably heard from, the earlier guests, to entice traders and holders to burn Luna, creators offered an almost 20% yield on staking on something called the Anchor protocol. So the pitch is turn your money into UST. You can earn 20% interest. And so before this whole thing went down, about 70% of UST's total circulating supply was deposited in that Anchor protocol strategy. When the whole thing started over the weekend, I think there was more than $2 billion worth of Terra that was sold really quickly. It dropped the price down. It depegged Terra from the dollar. Then everyone piled in for this arbitrage opportunity. A massive sell-off initiated. You know the story now. Domino, domino, domino. Within days, the Luna token and Terra had dropped to pretty much nearly zero. And the CEO was, scrambling on Twitter to get things back on track. People were jumping ship. And I think this is a really, really cautionary tale. Okay. One of the best things about Bitcoin, guess what? There's no CEO. When the price is dropping, you don't go to the CEO's Twitter page to find out what's happening and are they going to increase the supply and burn this or that. That's why I love Bitcoin so much. There's no CEO, there's no headquarters. It's just math. It keeps going block after block, and it doesn't care about the outside world or whatever recessionary indicators we have right now. So, I think people need to remember there's a lot of experimenting going on in this space. Some of those experiments will do well. Some of them will do well temporarily. Some of them will crash and fall on their face. And I think this is a case where one of those experiments is failing. I really am sad about the people, again, that lost their life savings. So be really, really, really careful. And Bill, with that, I'll kind of send it back to you. I know you've had, Do Kwon on the show before, and I know it's sad. It's sad when you see this, but at the same time, I think that it's good that we have a system that is much more capitalistic and much more the way our current system should be. No bailouts. Like if it fails, it fails. And we know what projects are good, what projects are bad.
Yeah, this guy's getting a lot of hate his way. And I don't think I don't think there was some kind of scheme to, deceive the public. I think there was a lot of mistakes made in how this was managed. I don't think they should have announced the Bitcoin purchases. He wanted to be a hero, so he prematurely announced the Bitcoin purchases. I think if they had put a collateralization model in place first, then announced the purchases, then I think the manipulation that happened would have been less severe or maybe even avoidable. I don't know. It's extremely complicated, and I've designed these things, and it's still very complicated for me to follow. So, by the way, the one thing, and you mentioned this, I tweeted about it. I actually think even with the meltdown, even with this huge Luna crash to zero, I actually think long-term, the single biggest announcement of the week, when we look back in history, is going to be the FASB announcement. Mm-hmm. And let's rewind and make sure that people understand this, because the vast majority of people don't even know what the FASB is. It's the Federal Accounting Standards Board. Now, that's pretty much the most boring 4 words you could put together to form a phrase. But what they do is they basically determine when you report your accounting as a company in the United States, what standards do you use to report that accounting? And one of the items that's in those standards is for asset appreciation, meaning if you hold something that's not dollars, whether it's a stock on your balance sheet or Bitcoin or property or whatever. And in basic terms, if the value of that asset goes up after you buy it and you don't sell it, you get no credit, meaning the value stays at the price at which you bought it. If the value goes down by some standard measurement, you must take the new lower value. So you get all the credit for the losses, but none of the credit for all of the credit for the unrealized losses, none of the credit for the unrealized gains. And that is pure insanity. It makes no sense whatsoever. Even if you just kept it at the price that you bought it at from a standards perspective until you sell it, that also doesn't make sense, but it makes more sense than what they're doing now.
Yeah.
This one fact is probably the single biggest issue keeping companies that are on the fence from putting Bitcoin on their balance sheet to
100%.
doing so. That is why I'm saying this is a huge, huge deal. And the only reason it's not getting more attention is, one, it's boring, and two, people don't understand it because it's accounting. But that's why I'm saying I think it's really important on Money Talks that we break it down a little bit, because and look, Michael's point on your show is 100% correct. They can't make it worse. So the fact that they're actually spending time on this means they're highly likely to make it better.
Mm-hmm.
Not only for Bitcoin, but I would guess for most assets.
Mm-hmm.
I don't know, but it's been like this for decades. So this is a big deal.
Yeah.
Anyway, I thought that how you got Michael to address that was super interesting. We've talked about the Luna stuff, I think, ad nauseum. I think it's all learning experience. One of the things you brought up about when in doubt, zoom out. I wanted you to just see this. So I'm going to share my screen for a second. There's my favorite chart on this, and this is Bloomberg Terminal, so you don't have access to this. And Bloomberg is incredibly expensive. You can't even see this on TradingView. But this is basically the log chart of Bitcoin from inception until now. And the red line more or less represents the median. The gray lines represent one standard deviation above and below the median. And you can see that outside of when Bitcoin was illiquid and first started, we've never been below that one standard deviation for more than a couple of weeks since Bitcoin's really started trading back in 2012, with the exception of a very short time last March of 2020. And we know what happened there. And it really looks like the same thing is happening again. We had peak fear in March of 2020, and we all know what happened after that. And we seem to have peak fear now. So that's why Rob Paul has been the master of pointing this out, and I give him all the credit in the world for that. And so this is the best explanation I've seen as to why we say when in doubt, zoom out, and how to translate that into real numbers. And if history holds, and it's not guaranteed to hold, right, it tells us that we're basically in historically extreme oversold territory for Bitcoin. Anyway, I'm not going to do a deep analysis today, but since you mentioned the when in doubt, zoom out, I thought it would be useful to show that. Natalie, fantastic update as always. We love having you on.
Thank you.
Thanks for that. And we'll
thanks
see
everyone. Have a great weekend.
Thanks a lot. All right, so we are way over. We're going to stick around. I don't care if it takes an hour, 2 hours. We want to give you a chance to get all your questions answered. So coming up next, we've got the awesome Abra team here to answer your questions, talk about C-Perks, whatever you want to talk about. But first, if you're holding your crypto in a cold storage wallet, you're actually missing out on a chance to earn yield, earn interest. You can earn interest on your crypto by keeping it in an Abra Earn account. We're adding new coins and tokens to earn, like DOT and Matic, as often as we can, so you can get yield on your holdings. Here's how it works. Check it out. All right, gang, welcome back. We're going to probably be 15, 20 minutes over today to give you all the time you would like to get your questions answered. We've got from the Abra team, Sonam Joshi, a director of product in the product management team. She works with Deepak, who you've all met on our previous Ask Abra Anything segments. And of course, the Brad Pitt of crypto, himself. Tanner Nelson is back. Tanner, our favorite AAA regular. I don't know if you realize how popular you are on the live chat, Tanner, but they're loving you, man. So Tanner is our director of customer support. He sees it all. You think you're going to ask a question he hasn't seen, and I seriously, if it's related to crypto, by the way, I don't want to, let's not go there. If it's related to crypto, related to Abra, he has seen your question. I assure you, we get thousands upon thousands upon thousands of questions a week. And all right, so Tanner, let's start with that since I went there already. Anything burning that you're seeing that you want to mention off the bat in terms of what's on top of mind for folks this week before we get into some specific questions?
Yeah, absolutely. There's a lot of questions still coming in about CPERCs. When are we going to be able to trade, things of that nature? Without rehashing too much for the audience that watches every week, I will say Bill himself gave a great response to this last week. So check out the episode last week. But in short, we're working on some new trading features. Plan on launching those new trading features. And once those new trading features go live, CPERCs trading will go live as well.
Yep. All right. We'll get into that in a little bit more detail. Any other topics that are pressing that you're hearing about before we get into some questions or give Sonam a chance to comment? Tanner?
Yeah, a lot of volatility as we've all seen. So questions about loans, how are my loans going to be affected? How is collateral affected? Any questions at all, reach out to our support team. You can get there, support.abra.com. We're available 24/7, 365. So feel free to reach out. We're happy to answer any questions that you all have.
Yeah, I should mention that we're not going to answer individual questions. I'm seeing some about loan capital calls. Those of you who may have collateralized loans on Abra, our system seems to be working as planned. So if you have questions on that, use the live chat in the app and they'll be able to answer those questions. I have seen a few come in. Sonam, good morning. How are you?
Good, thank you. Thank you for having me.
Pleasure. We're thrilled to have you here and looking forward to having you on Money Talks on a regular basis. So what's new and exciting in the Abra product world?
Yeah. So given that we've already touched on CPRX and we've heard about market orders, why don't I do a little step back and give a broader overview? So
sure, please do.
Firstly, this has been a consistent question. We hear it. We want to thank you for your patience, but do want to assure you that we are very close. The funny thing about trying to make things easy for the users is that it's not easy. And there's a lot of work that's gone in the back end to make things as simple as we can for our users. So overall, as you know, for CPRX trading, we're going to coincide the launch for that with market orders. And what market orders is, you basically can buy or sell an asset at the current price. So it's great for users who just want to move ahead with the speed of execution. But for those who are sensitive about the price at which it executes, which, in the last few days, I would assume majority of us are, it's really important to make sure that we're also providing some sort of price protection as these orders go through. So with market orders, we're launching, we're keeping all of the good stuff that we have today. You get to have a seamless experience. You can still move from any asset to any asset. You still get the visuals of what's happening with your open orders and transactions. But a unique feature that we're launching is price safety. And by having that enabled in the app, what we make sure is none of your orders get executed at a price that's worse than 1% of the market price. And on top of that, as you're trying to put in your order details, and we actually give you proactive guidance on what's the amount that you should buy or sell, so that you can successfully place the order, with no more than that 1% slippage. So it's cool. It's different. It's clearly very important given what we've seen for the last few days. But it's also been fairly challenging to build. So that's been one aspect of that. We have now moved on to a very thorough QA process, quality and assurance, because we want to make sure that what our users now see in the front end is predictable, is consistent, and is very seamless. So that's where we're at. And that's why there's that dependency of market orders with CPRX trading, because we want to make sure that our users have that price safety feature enabled with CPRX so that they're not negatively impacted by market volatility or low liquidity. So, Bill, I think you've mentioned this previously in Money Talks. We will be launching market orders on a rolling basis. So we've made pretty significant headway with all our bugs and in our QA process. So the first subset of users should be hearing from us very soon. I just want to apologize for the delay. I want to thank everyone for their patience. But I think if anything, the last few days have taught us is that our time spent on building and validating and testing price safety was the right call to make. So we have made significant headway, and it's coming to you very soon.
Yeah, look, I think the biggest issue is, not that we're doing a great job with quality assurance. I've spoken to the team doing that directly, and I fully support what they're doing. I think the biggest issue has been, we've screwed up in terms of setting expectations with users as to when this would be available. That's the bottom line. And I apologize for that to those of you who are angry in the live chat. I get it. I set an expectation. We didn't meet the expectation. And we take that seriously. We've had several meetings a week, just kind of, how to figure out the best way to set expectations with all of you, given that we have screwed this up in terms of how we've set expectations in the past. I'm not going to sugarcoat it. And that's on me. Those of you watching, if you want to direct your anger somewhere, you can direct it to me. That's fine. I can take it. And I probably deserve it on this one. But we're certainly not going to release something that doesn't work. I'd rather have your anger about us not being able to meet a release date than have your anger about, hey, I lost money because something you released doesn't work. That's just not going to happen. Okay. And that's the situation we're in. Okay. We've completely rewritten a big chunk of the trading system in order to address the fact that, newer coins like CPERX have wide spreads, and how to keep you from getting screwed when you trade something that has a wide spread, which is very common in the crypto space. So you can call it a scam. You can call it whatever you want. It's not. Okay. I'm putting my reputation out there, saying, as somebody who's one of the largest holders of CPERX, because I've gone out and bought it, that I want this to work right. And I have no intention of selling anyway, but I do, basically want to be very clear that we're not going to release something that's not ready just because Bill set some expectation that didn't work out correctly on Money Talks. So I'll take it on the chin for that one. All right. That's on me, to all of you watching, and that's fine. But we're going to get this right, and then we're going to release it. Okay. And it's way more complicated than any of us originally believed to get this right. No one has released a price protection model for cryptocurrencies that have wide spreads like Abra is planning to do. No one. Okay. And there's a reason for that. It's really hard because you have to go deep into the order book to figure out where your real price is going to be when you put in a large order for something that maybe isn't as liquid or has, wide spreads to begin with. So not an excuse, just explaining what happened, the logic here, why we're doing what we're doing, the approach we're taking. If you're upset, it's fine. Direct it at me. It's all good. But we will get there, I promise. And I'm not going to give it all away. We're working on an entire new plan for CPERX, how to improve it, how to make it work better for all of us. We're not going to get into details today, but this is something that we've already been working on for a long time, and we're taking the time to do it right. Okay. So I don't really have a lot to add to that. If people have specific questions, I'm happy to stay longer and answer them. But as it relates to CPERX, it is what it is. Okay. Was there anything else besides the CPERX that you wanted to address on them before I look at some questions, or should we take some questions?
We can take some questions.
Okay. There's a question here. Maybe I'll take this one. It was earlier. I wrote it down. Somebody wanted to understand that is there a risk in terms of using TUSD versus USDC? And I'll address that one. So TrueUSD is basically a direct competitor to USDC, which is USDC coin from Circle. The company behind TrueUSD is a company called Trust Token. Similar to Circle, they're a US-based money transmitter effectively. And when you say money transmitter, that's a government compliance licensing system that basically says you're allowed to hold funds that belong to someone else. Historically comes from Western Union or PayPal. And basically the same compliance model is applied to US-based stablecoins. You either have to be a bank, a trust, or a money transmitter. And a money transmitter is usually the easiest licensing to get. So most startups go that route. Sorry if that's more than you want to know, all of you, but that's basically, well, I'm telling you this because that's why effectively, in my opinion, you can trust the true USD model and the USDC model more even than you can trust Tether. Not that Tether is untrustworthy, it's just that they don't have as a centralized entity. Because when we talk about stablecoins, we're not really talking about crypto in the decentralized sense. Okay, let's call it what it is. Stablecoin is a centralized system meant to make accessing decentralized cryptos easier. That's what a stablecoin does. And so here we're actually talking about something that is US regulated and goes through all kinds of compliance audits. And so effectively, there's very little difference from a compliance and risk perspective between TrueUSD and USDC. USDC is better known. We support both at Abra. Eventually, when you wire in at Abra, you'll have the choice between going to USDC or TrueUSD. I don't have a date, back to the earlier comments, on when that will happen, but it will happen in the future. So we support both. We also support Tether, but we're not going to support Tether from a minting perspective. If you already have Tether and you want to move it into Abra, that's perfectly fine. You can put it in Earn, you can convert it to USDC, put that in Earn, whatever you like. So from a risk perspective, the way I would define it is the risks with TrueUSD and USDC are partially technology risks because it's basically based on Ethereum or maybe Stellar, based upon which blockchain you're using to access the stablecoin and the funds backed in the stablecoin. And look, the name stablecoin is really a misnomer because these things fluctuate on exchanges. If you watch the price between USDC and Tether, for example, it fluctuates up to 1% a day. That's huge for something which is supposed to be pegged to the dollar. Abra doesn't control that. The government doesn't control that. The banks don't control that. The free markets control that. It's simply a function of supply and demand. This week, there was more demand for USDC. So the price of USDC versus Tether was higher because, a lot of retail consumers were afraid of Tether. So they were moving out, or maybe they were moving out of Luna into USDC when they could. And by and large, Luna is no more. Certainly shut off on Abra, and we have no intention at this point that I can tell to turn it back on. And so anyway, sorry for the long rambling, but that's the basic, I think, risk model when it comes to a dollar-backed stablecoin. All right. Todd asks, why is there a 5 BTC trade limit? I'm not sure which one of you wants to take that one. Tanner, you probably get that all the time.
Yeah, we do see this question from time to time. As far as the why, I think SJ is probably a good person to speak to that. And Bill, I'd like to hear your insights as well. Sure.
But if somebody wants to trade, the equivalent of 10 BTC, what should they do?
Yeah, reach out to us. There's a lot of nuance to different types of requests. And obviously there's a lot of considerations that we need to make with accounts and things like that. But if you reach out to us, we can figure out a solution to most any problem. And that's really what we're here to do. From a support point of view, we want to find solutions. That's the name of the game for us.
Okay, so there are solutions to basically trading in higher amounts. And if people want to trade in higher amounts, they can contact support directly and make the request. One option might be to break it up into more trades, but in many cases, we can help people with trading in larger amounts. Sonam, did you want to add anything to that?
No, I think, this is not a hard and fast rule. So it's based on what we think the market liquidity would be right at. So, again, we want to make sure you're getting the right execution. So that's the call we've made. but it's not a blocker. So if more is required, then definitely reach out to customer support. And again, we have a direct line with customer support. Like Tanner and team talk to us all the time, maybe too much. So if we consistently hear from customer support that actually we want to expand that, we have the flexibility to do so.
Does product team fear the beard? Is that what you're trying to say?
Yeah, there's like a little a meme of Tanner that's like just embedded on a screen.
Okay, not safe for work. I got it. HR is watching. So, all right. So, look now. The Twitter verse here is helping me run the show. They're reminding me to tell everybody that our own users that we have a great private client services group to address this. So if you are trading in much higher amounts, you're coming in 6-7 figures, by and large, we do have a private client services team that can help you. And if you go to the Platinum website on Abra.com, you can contact them directly or just send an email to platinumsales@Abra.com, and somebody from that team will reach out to you and validate that you're a good fit for that offering. So thank you to our users for reminding me of that. Jake says, I feel like USDC has less counterparty risk than True USD because the Center Consortium has 2 members, meaning 2 companies have to fail for the coin to fail. Yeah, Jake, that's not actually true. The company's failing has nothing to do with the coin failing because of the nature of the way money transmitter laws and banking laws work, and also because of the way it's set up. I don't want to spend a lot of time on it, but the bottom line is that's the way you said it isn't really true. So I'm not that worried about the balances in US-backed stablecoins vis-a-vis the companies themselves failing. That's the good news. The bad news is that it's a free market, and if the market decides for whatever reason that it wants USDC instead of Tether, the price of Tether could plummet. Right? There's nothing that we can do to stop that. And that's, so whenever somebody tells you there's no risk in a collateralized stablecoin backed by dollars, they're not being intellectually honest. Okay. And we're certainly not going to sugarcoat it here. Look, I have a significant amount of my net worth in US dollar backed stablecoins, USDC and TUSD and Abra. And I'm very comfortable with the risks associated with not only holding those stablecoins, but with the model that we use at Abra Earn. And Nick was asking me a question to remind everyone how that works. And I apologize to both of you. I'm guessing you want me to take that question. So Abra Earn, it's got a very sophisticated set of risk management processes around how we do lending, institutional lending, retail lending, minor lending, a small amount of DeFi, in the Earn system as well. And all of that basically translates, with our partner Prime Trust into a yield that they pay you on those accounts. And I think we have the best risk management businesses in the space. And that translates, in my opinion, into the safest high yield in the crypto space. And we try to disclose everything we're doing. That's why we do these shows. That's why we have the FAQs and the supports. I want to be as transparent as the team is with me, with all of you. So keep the questions coming in that regard. Let's see. It's already 10:20. What a day. So hopefully that answered the questions on the safety of funds. We also maintain reserves, right? So one of the reasons you may ask is, well, if all these funds are being put to work, why am I able to withdraw my funds so quickly? Well, for the average user who might be holding, let's say, less than $100,000, that's way less than the amount of reserves we're holding that aren't being lent out. And so that's why we're able, and that actually effectively lowers the amount of interest that everybody's getting because those funds aren't being put to work, but it's a safer way to manage the system and for all of us. Okay. So whether there's lots of deposits coming in or for whatever reason, lots of withdrawals going out, it doesn't really matter. We're able to manage this appropriately. Okay. Paul says, as a software engineer, I cannot imagine the complexity of programming an order system with price guarantees routed via third party, mind-boggling. Not really a question, but Paul, you're absolutely correct. And you've only scratched the surface with your comments. Let's see. A lot of market-oriented questions today, a little less on product. I guess all of our users are pretty comfortable today. Given one of the problems with Terra was subsidized yield, how should we think about Abra offering 7.5% on stablecoins, but offering loans? So Eric, that's a great question. The two have nothing to do with each other. Effectively, the yield that Abra and Prime Trust are offering you through Abra Earn is 100% via the lending model that I described. You know, institutional lending, retail lending, all based upon collateral and over collateralized loans, and certainly in the case of retail, small amount of DeFi, all basically comes up with a number, whether you're getting yield on Bitcoin, Ethereum, the dollar stable coins, it all comes from the same formula, as opposed to going to something like Anchor, which has its own formula, which basically involves literally giving you altcoins, which you can either hold or sell. Obviously, that's failed now in the case of Luna, but the two are completely different from each other. Okay, so the subsidized yield model of a Terra has nothing to do with Abra. Now, you may choose to use certain DeFi pools, liquidity pools that Abra offers eventually in Earn, and then that risk is on you. That's separate from accessing our dollar loans, and the app will eventually make that very, very clear once we start offering those products. And those will be less safe than just using the straight up, standard stablecoin Earn product that Abra offers today. Let's see. So Kurt was asking, with this model that you're describing, can the person accept more than 1% slippage? So why don't you maybe, Sonam, explain what that means, and then you can answer.
Yeah, absolutely. So if the speed of execution is still of the essence over the price at which it executes, you can simply disable the feature. So what we'll do is the feature will always be auto enabled as default. But if we give you the warnings, we say, I think you should be putting X amount for this to be within 1%. If that's something that you're not interested in, you can simply disable that and the trade would execute.
Right.
It would happen at the price with the spread.
So you can end up with 3, 4, 5% slippage, but then you're accepting that as opposed to the price protection that Abra is giving you. In that case, you'll probably get for lower liquidity digital assets, you might get a faster execution, but with a higher spread between spot and the current spot and execution price.
And you'll get a notification just as you're about to confirm the order. We will double confirm that you're okay with the pricing being worse than what we're seeing today.
Yep. Okay. Let's see. Yeah, Catherine said, we don't want government regulation of crypto. We do want a free market ecosystem, but crypto investors need a way to accurately evaluate risk. Any talk about the OGs organizing a rating system? So Catherine, there actually is a US-based organization. I forget the name of it. A bunch of the exchanges are members, and they actually analyze crypto projects to try to determine, according to the Howey test and other issues, for example, what's a security, what's not a security, with the idea that they basically probably wouldn't list things that they determine are securities. And it's not really a rating that's public, but it's more or less the combination, as I understand it, lobbying and also analysis. And it really helps companies that are projects that are trying to get new tokens listed go through that process. But I haven't seen anything else other than that, and I don't hear much from it these days. But it's an interesting question. I have not seen anything around rating. I'm not even sure what it is you'd be rating, right? Are you, what is it that you're, from a qualitative perspective, what is it that you're providing a rating on? I'm unclear. Especially in the more decentralized something is, probably the less a rating matters, because hopefully, like you said, the public markets do their thing. Deepak asks, hi, Bill, how do you see the upcoming recession affecting the yield on USDC on your platform? That's a great question. So Deepak, I think the first part is that the yield that gets paid on digital assets in crypto is decoupled from yield that the banks pay or interest rates that are mostly government driven. and repo market driven. Okay, the two have nothing to do with each other. There's a demand curve in our world that exists because the traditional banking system doesn't service the digital asset space. And that's going to probably be true for the next 5 to 10 years. So the second part of the answer is it really depends upon whether a recession changes the demand, meaning are funds that borrow or miners that borrow or consumers that are accessing crypto gains going to continue to borrow? And if they do, it's business as usual. And if they don't, it'll affect rates or they could increase the demand, right? So we'll see. I suspect there wouldn't be a huge change, but time will tell. Now, if crypto, with the big exception that if crypto prices really tank, I mean, if we see 15,000 Bitcoin, I would suspect rates would come down, but I'm very skeptical. And I've tried to be as intellectually honest as I can here. I'm very skeptical that would happen unless we just, like I mentioned earlier with Vinny and Ron, unless we see runaway inflation, reported inflation in the 15 to 20% range, which I seriously doubt is going to happen. I think the high oil prices that we're experiencing now have taken care of that for us, and the bond markets have taken care of that for us. So I guess you guys are doing a great job because we're getting a lot of questions today, but a lot of them are market-based, kind of hypothetical. So how protected is my crypto at Abra in case of bankruptcy versus Coinbase? So Michelle, I guess you're referring to Coinbase's comments. It was very strange the way they did that. They didn't really need to word it that way, Coinbase, in their terms, because when you're a money transmitter or a bank trust, that's not really what happens to consumer funds. In other words, consumer funds don't really get commingled with the balance sheet that way. The banking system kind of steps in and does its thing. So especially if you're dealing with a legal custodian that's regulated in that system. So I'm a little surprised that the lawyers got the better of the management team and kind of forced them to word it that way. I'm guessing that the CEO probably didn't even know that was coming and was probably blindsided himself because there's a million and one things going on. All right, it's 10:30. And we've talked about, I'm still getting CPRX questions. We've already talked about CPERCs. You can go back and listen to some of my comments. Tanner, your team is doing an awesome job. Thank you so much. We didn't have as much product questions this week, but we're getting a lot of, I think with the pain out there, I think people really want to know where it's going right now. And so my guess is that when things are screaming up and to the right, people are going to want to know when the next feature is there. So it's the mindset is probably a little bit different. Jake is asking one last question. This is a good one. Jake is asking if the Crypto Banking Alliance has applied for CPERCs listing on various exchanges like Coinbase, Binance, Kraken. My understanding is they have, and they're working with them. I have no update on it. I'm not directly involved in the process. I've made a couple of intros, but the CBA manages that based in Switzerland. And so my understanding is that those processes can take months. I'd hoped it would go faster. But it is happening. And I think with the 2.0 plans that Sonam and the product team are working on, I really think that we'll see CPERCs and listed in a lot more places as well, which we hope happens. Anything, Sonam, any closing thoughts?
No, I think just want to reiterate a couple of things. I think firstly, it's really reassuring to see how so many of our internal conversations are so closely aligned to the user feedback that we're getting, and be it through money talks, social media, customer support. So just really good to see that how so much of this user feedback fuels our discussions and our roadmaps. So definitely please keep it coming. And then secondly, the key goal that we're trying to do with all of our products is not to replicate what's out there, but to go with something that's really differentiated. And that does come with, diving in deeper and building something that's untested and unchallenged. So it does take us longer than we'd like, but to Bill's point earlier, it's not about coming in fast. It's about coming in with something really good. So that's what we're focused on. So again, if timelines are shifting, we apologize, but we're definitely excited to bring you some really cool features in the very near term.
Cool. Tanner, thanks, Sonam. Tanner?
I just want to say thanks to everybody for using Abra. Thanks for your patience. Thanks for your understanding. We appreciate it. We wouldn't be where we are without you. And yeah, we're doing everything we can as an entire organization to be everything that you want us to be. So thank you.
Yeah, well, I wholeheartedly agree. The support team is there for you. I get feedback all the time from friends of mine that, they use the support. They used to call me. So now they call support and they say, oh, it's great. We don't have to bother you anymore. So I love that. And you guys are doing a great job. Product team's doing a great job. I do have a couple of other questions I'll take, and then I'll call it a day. So if y'all want to head out, that's fine. I'll just take one or two more questions here. Excuse me. My personal take on CPERCs, I keep getting this question. I don't know why, but I keep answering it over and over. I'm super long CPERCs. I also, I wouldn't sell anyway, but I'm really excited by where it's going. There's a lot of things we're doing on the product side that are going to be CPERC centric that I'm really excited about. And, I'd probably be buying more, but I'm super long already. It's a big chunk of my portfolio. And I'm all in. I've earned a lot just like you, but I've bought even more. And, I am probably going to buy a little bit more, but I'm super long now. Let's see. And then there was one other question somebody asked that I thought was a good question, and now I can't find it. Yeah. All right. I'm going to leave it at that. So it's already 90 minutes, the longest show we've ever done. And it's because of all of you. If you weren't interested, I wouldn't do it. And we love it. So thank you so much, Sonam. Thanks, Tanner. Thanks, Ron. Thanks, Vinny. Thanks, Natalie, the producers, the audience. It's awesome. So look, I think that we're going to get through this. We've seen this dance before. If you've paid attention to the markets, this is not the first time we've gone through this. May not be the last. I think each one is getting a little bit easier of a pill to swallow. I think we've reached... I do think we are pretty close to maximum fear. My guess is we go sideways, maybe a slight dip, which I don't really care much if we do or don't. More importantly, I do think that, the second half is going to be bullish for risk on assets, because I do think the economy is slowing and people are going to be more or less pricing in the Fed assuming that they want to avoid a deep recession. We'll see. We'll let you know our opinion as we go. We'll get others on to give us their thoughts. In the meantime, stay smart, educate yourself, stay safe. And we will see you. Actually, we'll see you from Palm Beach next week during Permissionless, where we'll be broadcasting maybe with a couple of guests. So we'll see. All right. Have a great weekend, and we'll see you next week. Take care.